The roll, please.
Of course. Cindy Butt,
Here.
there you are. Wendy Clark, Heidi DeWeingart,
Here.
Claudio Gualtieri, Commissioner Mascara Bruno, Lisa Tepper Bates,
Here.
Greg Ugalde.
Here.
We do have a quorum in attendance for the meeting.
Okay, are we expecting Sayla to join us?
As far as I know, I
Okay,
don't know if anyone else has better data than I do.
all right. Are we waiting for anyone else that said they were coming that isn't?
Not that I know
Okay.
of. I thought Wendy was going to be able to join us, but it was but I'm not entirely sure.
Okay. All right, well, since we have a quorum, let's get started. First item on our agenda is the resolution regarding the financing of MLK Apartments, which is located in Hartford, to be presented by Sarah.
Hi, everyone. So this request is for tax exempt bond financing in an amount not to exceed $40.3 million, which loan would be structured as a construction loan of approximately $21 million with interest-only payments for 2 years and then fully paid off at maturity, and a perm loan of approximately $19.2 million, which will be interest only for 2 years and then fully amortizing for a term of 40 years. There's also a request for CHFA's subordinate financing for a subordinate mortgage of up to $1 million. This loan will accrue interest during the entire 42-year term, and payments will be made based on adjusted cash flow after payment of the deferred developer fee, which is expected to be around year 14 of operations. The development is currently a vacant 64-unit multifamily complex in Hartford, built in 1968 as public housing for families that were displaced by urban renewal projects. It has more recently been run by Sheldon Oak Central, a Hartford-based affordable housing nonprofit. In the past 50+ years, the building has experienced substantial deterioration. And over the past 3 years, all families that were living on site were relocated permanently to surrounding neighborhoods in anticipation of this renovation. And that relocation, the plan for that was reviewed and approved by DOH for universal relocation, compliance with the Universal Relocation Act. All the families that were living there was a total of 55 that were relocated. They will all have an opportunity to return if they so choose. All of the buildings that are currently on site will be razed. The site will be remediated, and then a new, denser, more energy efficient, safer, and accessible sort of neighborhood will be built on site. The development will include 155 units, all restricted to households at 50 and 60% of AMI. The project will also benefit from 38 project-based Section 8 vouchers, which will allow them to also serve lower income populations. And it's located less than a mile from downtown Hartford, in an area that has seen a great deal of renovation lately, and economic development. That, combined with all of the amenities that are planned, the development is expected to be well received by the market upon completion. In addition to CHFA financing, the project has received substantial support from Department of Housing with both state bond funds and federal home dollars, totaling $11.7 million, as well as a $3.75 million community investment fund grant from DECD and 4% LIHTC equity. The development team here is a partnership between Vesta, a for-profit developer with LIHTC experience in several states, including the Camelot in West Hartford, which was just approved by this committee and the board back in September and is now expected to close by December. And then also Sheldon Oak Central, the nonprofit. The GC is La Rosa and the syndicator is National Equity Fund, both of which have extensive experience working with CHAFA. CHAFA, DOH, and HUD environmental reviews have all been completed. And the development team is really hoping for a quick closing after CHAFA approval. Any questions?
Heidi, this is
Heidi.
Lisa.
Yeah, go ahead, Lisa.
Hi. Sarah, thanks. That was terrific. And it does indeed look like this would be a significant improvement over what that property, the condition of that property right now. I do just want to flag for the committee, as we've discussed in the past, that the fact that this is fully affordable at fairly low income rates on one hand is a good thing. We need affordable housing, but we also need to just continue to be conscious of the fact that there is such a surfeit of affordable housing in this very area that it actually does impact the local economy. And we've talked repeatedly about how much better it would be if instead of these fully affordable projects, we could have a mixed income development, which are widely recognized in this area to be more successful. That would be better. I understand, and Nandini has flagged to us in the past that there are not products available to us easily to make that always possible, but we should just bear that in mind. And Sarah, I don't know, and forgive me if I missed it, in this particular area, what percentage of the housing is deed restricted affordable? Do we know?
Yeah, I believe it's 18%. Let me just double check. Oh no, it's 40.7%. So
In this area, not in Hartford as a whole.
oh, that's in Hartford as a whole. We don't break it down to just
Yeah.
the neighborhood, but yeah.
Yeah. So we know in some areas, as our former colleague used to cite from the Partnership for Communities, for Strong Communities, some parts of Hartford are actually above 60% affordable housing, which creates a challenge. So I think it's important. I mean, this again sounds like a good project. I'm happy to vote yes on it, but we just need always to keep coming back to that question that in doubling down and increasing that stock of deeply affordable housing in places where there is already such a high percentage, we are in fact potentially adding to a problem that already exists there. So I just want us to bear that in mind and hopefully to keep coming back to what we can do in future to potentially use this type of opportunity instead to introduce mixed income. So thank you, Heidi.
I'm not sure that it's not a chicken and egg question, right? By the time we see the development, there's plans and proposals have been made. So to say, oops, think about making it more mixed than skewed. That's a challenge because we're seeing it later in the game.
Right. Hey, Joe,
Director, yeah, I just wanted to provide a little bit of history on this. This transaction goes back a few years with the development engagement process with the Department of Housing and CHFA, and prior iterations of this transaction were heavily incorporating a market rate component. CRDA was involved with some funding, and because of rising interest rates, rising construction costs, those market rate components were steadily eliminated to enable more tax credit equity and more DOH funding to come into the transaction to be able to cover those additional development costs. So I agree with everything that Director Tepper Bates had said. It's something that we've encouraged, but steadily those components were eliminated in favor of balancing a budget that would enable the entire project to be completed.
Thanks for that background, Joe. That's a shame, but I think it's very worthwhile to keep coming back to this discussion and to think as creatively as we can in future. But obviously those constraints are real. Thank you.
Just to follow up on that too, when we see 100% LIHTC eligible in the breakdown between the 1-bedroom, 2-bedroom, and 3-bedroom, how is that decided? It looks like a pretty good breakdown to me, but yeah, I don't know, light on threes, or, I'm sure it's what the community can support and needs, but how is that determined?
So the development team, determines that, but then we do review it, and we review it for unit parity. So to make sure, we don't want to see all of the lower income bands at 1 bedroom and all of the higher income bands at 3. So we do review that, and we have standards in our LIHTC guidelines that require unit parity to be met.
I'll just add to that and say that there have been some developments that have established that unit mix strictly dependent on the existing tenant base who they expect to relocate back to the project. So it's a combination of multiple factors, as Sarah said. But in this case, it was the combination of community need, the market study, and what they anticipate for residents returning.
So this is our second project with Vesta, and I'm sure we talked about them on the first one, but I don't remember. What do we know about them, and more importantly, how has the process been for the first deal that hasn't closed yet? But how's that going?
Yeah, Heidi, we're about to close that. We expect to close that by December 6th or 7th. So
Okay.
it's been moving along. And while they may not have direct experience with us, all the members of the team have had development and affordability management experience in their histories. It's just a new combination of players, I guess, is the best way to say it. It's a new team, but with old players.
Okay, so you're comfortable.
Yeah, so far. And we're keeping an eye on this because we have Camelot, which is going to close, like I said, December 6th. We have this one, and then we have another one following this in New Haven called the Monarch. So we're going to keep our eyes on this group to make sure that they can produce as expected.
Yeah, this is a big project, obviously, and yeah, I saw there was a sentence in here about capacity to manage. So I would glad you're keeping an eye on it.
I have a question about the closing, Heidi.
Sure.
A reference to winter 2024 closing. What does that mean? And do we typically approve funding this far away from closing?
The closing in winter of 2024 will be the first quarter of 2024. And so that's just about the right timing. We have a bunch of things that have to go that have to get provided after this approval in order for us to close. And we have advances that have to be made, and
so early next year, not late next year.
The winter, Wendy, this got me too when I first saw it. The winter of 2024 is January, February, March of 2024.
Got it. Thank you.
Yeah. I thought December was winter, and so so it's coming
true.
up.
Good point. Anybody else? More questions? Comments?
I'll make a motion to approve, Heidi.
Thanks, Greg. Is there a second?
Second, Wendy.
Okay, thanks, Wendy. All right, Dawn, can you call the roll, please?
Yep. Cindy Butts,
Yes.
Wendy Clark,
Yes.
Heidi DeWeingart,
Aye.
Claudio Gualtieri, Commissioner Mascara Bruno, Lisa Tepper Bates,
Aye.
Greg Ugalde.
Aye.
The vote passes unanimously.
Thank
And
you.
Heidi, I received a text from both Nandini and Selah, and neither one of them will be able to attend,
Okay, thank you.
just so everybody knows.
Okay. All right, next up on our agenda is the resolution regarding financing for Oak Woods apartment, which is in Terryville, Connecticut. I had never heard of Terryville, but now I know where it is. And to be presented by Stephen.
Hi, everybody. So the request is to approve a permanent only first mortgage of up to $3 million from taxable bond proceeds with an interest rate of up to 7% and a permanent term of 40 years, amortized over 40 years as well. Amortization will commence upon the earlier of the 25th month following the initial close, or when final closing is achieved and continued through the 40-year permanent term. Additionally, there will be a second mortgage from the Opportunity Funds. There'll be a construction permanent mortgage of $1 million with an interest rate of 1%, and a construction term of 24 months, along with a permanent term of 40 years. For this one, the loan will accrue interest on outstanding principal at a rate of 1% per annum, payable interest during the 24-month construction period, and then it'll accrue interest at a rate of 1% during the 40-year permanent term. It'll be payable with 25% of adjusted cash flow after deferred developer fees paid off. To give some details on the development itself, Oakwoods Apartments was awarded 9% tax credits in 2022. The development is a new construction development consisting of 47 units and a total of 8 buildings on 26 acres of land. And this is in Terryville section of Plymouth. So the development for the 47 units, they will all be two-bedroom apartments. They will utilize the average income minimum set aside. In terms of the income bands, there will be 12 units for households at or below 30% of AMI. 20 units for households at or below 50% of AMI, and 15 units will be at or below 80% of AMI. For the lowest income band, it will also serve formerly homeless individuals with disabilities with the supportive service support of Columbus House. 6 of the 12 units will also receive Section 811 subsidies. Going to the details of the building itself, it will have some amenities. The amenities will be the clubhouse, which contains a community room. The development will also be built to LEED Platinum and passive housing building standards with FIAS and LEED Platinum certifications. So this will result in energy and cost savings, high indoor air quality, and soundproof apartments. Oops. Sorry, my computer froze. Going to the development team itself, the developer is HF3 Group, LLC. They're a Georgia-based developer. Harold Foley is the CEO who we deal with. They have numerous developments in Connecticut, including some LIHTC, some developments that include LIHTC allocations. Some of those developments include Carroll Apartments, Cherry Apartments, Rocky Neck Village, and Brookside Commons. The GC will be Haynes Construction Company, which we also have experience with. Some of the developments they worked on that are CHFA funded are Farm Court Phase 2B and Westbrook Village Phase 3. The project architect is Wallace Architects. They're actually based out of Missouri, but we do have some experience with them. They helped with the development of Carroll Apartments, Cherry Apartments, and Rocky Neck Village. But we will also, or I should say the developer will also contract with the local Connecticut architect for the construction administration services. And then lastly is the property manager, who is Maynard Road Corporation. We also have some experience with them as they manage 24 Colony and Chamberlain Heights. Going to the location itself, as I mentioned, it's located in the Terryville section of Plymouth. This is a community with only 7.7% of affordable housing. Plymouth only has a population of 11,664, but the development is within a two-mile radius of grocery stores, pharmacies, and libraries. There's also the high school and middle school that are nearby, within a mile away, and Bristol Hospital is approximately 4 miles away as well. We did commission a market study, which confirms the proposed rent schedules for the affordable units are consistent with market conditions, and they are reasonable. Additionally, we commissioned an appraisal, which provided the prospective as complete value of the property at $3,970,000. The loan to value ratio for the primary loan is 60%. The loan to total development cost is 14%. Going to the financial structure, the total development cost is $21,975,000, or approximately $462,000 per unit. Total construction costs are $14,500,000, or $304,000 per unit, approximately. Outside of the permanent financing and the opportunity funds, the source of funds include approximately $12,572,000 in 9% LIHTC equity, $5,400,000 in DOH funding, $260,000 energy rebates, and $344,000 for developer fee. Also for the construction loan, that will be with Webster Bank. They'll provide a construction loan of up to $12,766,000. And then lastly, just going to the strengths of the development. The development will create 47 units of affordable housing in a municipality where only 7.7% of housing is affordable. The site is in a convenient location close to hospitals, schools, grocery stores, pharmacies, and libraries. The development will provide 12 supportive units for individuals at risk of homelessness. And this is in a town where they really, there's limited affordable housing. So this will be really good for the, town of Plymouth. Also, the owner is an affiliate of HF3 Group LLC. So we do have experience with this developer. And they have assembled a development team that has experience with the Chaffa transactions. There are some challenges. The first challenge will be, we'll be locking the interest rate at construction loan closing and not dispersing funds for 2 years. So because of that, the interest rates could change significantly, within the 2 years. Delays or cost overruns during construction may impact the budget. The LEP review is in the final stages. The review is expected to be closed out very shortly. And then lastly, there are a total of 3 parcels of land. A phase 1 environmental report was performed on a parcel of land 49 Scott Road. This is the majority of the 26 acres at 19.71 acres, but there is a phase 1 currently being completed for the additional 2 parcels of undeveloped land, 431 Main Street and 435 Main Street. The report is expected to be received by early December. And for the mitigating factors, I'll kind of jump ahead and just note that, the development is sited on a larger 19.71 acre parcel. These other 2 parcels are currently undeveloped and wooded. So no development activity will take place on either of these parcels. So
there's going to be a restriction that they're not allowed to, or they're just not planning anything at the moment?
It's not part of the plan. Yeah,
exactly.
So they're building 47 units on 19 acres. That seems like a lot.
Yes, they're townhouses with, I think they have garages. So they actually have a pretty big footprint.
Just quickly going through the last couple of mitigating factors. The developer does want to close beginning at the end of January 2024. So the closing should be, is planned to be shortly after if this is approved. The GC has been actively constructing since the beginning of the pandemic with little interruptions or impact to scheduling. And then lastly, we do have minimal risk during construction as only the opportunity funds will be used during construction. That sums it up. Does anyone have any questions?
I have a question.
Okay.
Go ahead.
So this 19-acre parcel, when it says no development activity will take place on either of these parcels, how come? Is it restricted from being used, or they're making the decision, or they're just not doing it for now, or?
No,
So
Cindy,
go ahead.
I was going to say that the plan, it's really 26 acres, but they were separated into 3 different parcels. The plan, the approved plan, is cited on the 19 acres. The other 2 parcels that are adjacent just are not part of the development. There's no restrictions on it. It's just not part of this financing. And there's no intent to develop the project, the parcels in the future. We will be taking the other 2 parcels as security, so they won't be able to develop it without our either partial release of those or our approval of any future development, so.
And does it take the entire 19 acres to do the development, or is that a lot of open space?
There's a good portion of open space, obviously, but again, these are townhomes, so your units are vertical rather than
Right.
stacked. So a lot of times we see smaller parcels, but that's because they're stacked and they go vertical. These are much more horizontal application, garages, so they take up a lot more space. And then there's parking and such.
Okay.
What
So-
happens, we're locking, sorry, Greg, we're locking the rate 2 years in advance. I assume, we all hope rates will come down in the next 2 years, but we'll see. So
Yeah.
I assume we have some kind of prepayment penalty if they want to renegotiate the rate.
This will get re-underwritten in 2 years.
Re-underwritten. So if rates go up by 5%, it doesn't work, what happens?
Right, yeah, but that's
That's
how,
Webster's problem.
that's Webster's problem, correct. We do a forward commitment with the understanding that we will re-underwrite the deal at the time of the permanent financing. And so we'll resize the loan at that point. We build in a 50 basis point cushion over current rates. So so that we've sort of projected higher rates, but then if the rates are lower, we could provide them with the finance, you know, the up to amount on this request.
Okay, so we're not taking the risk of it.
We're not.
Okay. Who else?
I think Joe has his hand up, and Joe, I apologize. I can't find my hand on this new
I can't either.
setup somehow.
It's
It's,
all right.
it's
I
under
just have-
reactions.
I have one quick thing. I'll try that in a second. It showed like a clap, and I didn't want to start clapping at an inappropriate time. So, but I do have a question how the 6 units with Section 811, and also the 12 supportive housing units, that's just a snapshot, right? What happens? Are they required to be that into the future, or is that how, again, with existing tenants, or it looks like when they build these, they must have a plan that they're going to support that many at the outset, but will that be continuous, I guess is the question.
So it will be continuous. As of now, there's only 6 units where they have an agreement for Section 811, but they are actually looking to subsidize those remaining 6 units. They are actually they're talking to Tawny currently. So it should be the 12 units will be subsidized for the supportive services. But as of now, for the snapshot, it's only the 6 units. So I hope that answers your question.
So Greg,
Yes.
they have an obligation to keep the 12 units supportive throughout the ELIC period. And right now they have subsidies for 6 of those 12, and they're seeking an additional 6 subsidies for the the remaining.
So I sort of had to laugh when it said this town only has 7% affordable
Yeah.
housing, which is high for so many of the towns in Connecticut. But once these units are built, I know, isn't it the goal to have at least a 10% of every
You have to-
town?
Yeah, that's the 830G requirement, Heidi. And
Right,
most of
right.
the towns just put into effect last year their affordability plans.
Mhm.
And most towns we're seeing, even on market rate development, are requiring like 10% of all newly developed units to be affordable and qualify under 830G.
Right, so I think Terryville's doing a better job than most.
They're getting there.
They will. Okay, any other questions or comments?
There's a couple of hands up.
I can't see hands, so
Oh,
Yeah, I
speak
can't
out.
either.
Lisa, why don't you go first? You're on mute.
Thank you, Pat. So actually kind of following up on Greg's question. So it's a little bit confusing. So there's 6 units that are 811 and specifically for people exiting homelessness, if I understand properly. But then there's a statement in here that 12 units total are for people at risk of homelessness. But 6 of those are the 811 for people exiting homelessness, if I understand properly. And also, I just want to make sure, I should probably know the answer to this, but do we have a consistent definition of what we mean by people at risk of homelessness? What do we mean by that?
So that's basically based on the contract itself between Columbus House. You know, they're in agreement that you know those units are for at risk of homelessness. So I
Do
don't.
see-
Oh,
Terry Nash, I thought I saw you earlier. Can you address that question? I thought I saw her on earlier.
I thought I saw her too.
Yeah,
Here I
Lisa, we
am.
can-
I'm sorry. I'm
That's okay.
struggling a little to get off of mute. But yes, I can. We do have a definition published in the supportive housing guideline. Basically, anyone who is going to be providing supportive housing in their development can see exactly what's required for homelessness definition, at risk of homelessness, imminently homeless, chronically homeless, the whole iteration. And we provided those definitions to put them all in one place because we get them from HUD. It's a national standard. And I'll look it up for you if you'd like. Very quickly.
Yeah, it'd be great to just see that and make sure, you know, being at risk of homelessness is a little bit, I'm afraid, like, you know, beauty is in the eye of the beholder. It can mean a lot of different things. So it'd be useful. I don't know if others on this call would like to see that again, but I'd like to see that. And it'd be interesting just to think about, you know, being really very consistent about how that is implemented to the extent that we can, you know, can ensure that. So thanks for your work on this, Steve, and thank you, Terry.
You're very
so-
welcome.
Terry, we'll send that to Dawn, and then Dawn can send it out to all the members of the mortgage committee.
Perfect. Thank you.
Okay, any other hands up that I can't
Nope.
see?
Joe, do you still have your hand up?
I do. I just wanted to clarify Director DeWeingart's point about with interest rates going up. For all of these permanent only loans, we have an origination fee funded at initial construction closing. So essentially, it becomes a non-utilization fee if they opt to secure financing other than ours. So while we are at risk with our 2-year forward rate cap, if rates go down, we get compensated if they don't end up using the perm loan.
Okay. Thank you. Anybody else? Any other comments, questions, concerns? Okay, do we have a motion?
So moved.
Thanks, Lisa. Second?
Second,
Thanks, Greg. Okay, Dawn, could you call the roll, please?
Cindy Bucks,
Yes.
Wendy Clark,
Yes.
Heidi DeWeingart,
Aye.
Claudio Gualtieri, Commissioner Mascara Bruno, Lisa Tepper Bates,
Aye.
Greg Ugalde. Greg, you're muted.
aye. There
Thank
it
you.
is. Thanks.
Thank you so much.
you.
The vote passes unanimously.
Thank you. Okay, next on our agenda, I believe, is the minutes from the mortgage committee. Or am I out of order, Dawn? I have the minutes.
You are correct.
Okay, so anybody have any comments or changes to the minutes of our meeting of October 24th? Okay, hearing none.
Motion to approve?
Thanks.
And I'll
I'll
second it.
Okay, thank you. Dawn,
Cindy Bucks,
Yes.
Wendy Clark,
Yes.
Heidi DeWeingart,
aye.
Claudio Gualtieri, Commissioner Mascara Bruno, Lisa Tepper Bates,
Aye.
Greg Ugalde.
Aye.
The vote passes unanimous.
Thank you. Okay, now up is the homeowners report to be presented by Kayla.
Good afternoon, everyone. Hope everyone had a nice holiday. So I'll kick us off with the first mortgage loan activity. Thanks, Dawn, if you can just to the next slide. So far this year, we've done over 2,400 first mortgage loans. As you can see, this is a big uptick from the previous year. And if we tab to the next page, we'll see that that activity has also occurred in our down payment assistance, primarily driven by time to own. So we saw, time to own bringing in a lot of buyers who also use our first mortgage programs. And then on the next slide, here's the time to own highlight. We've done over 2,800 total reservations for the program, and just over 30% of those reservations have occurred in high or very high opportunity areas. Drawing your attention to that second chart where we look at median income, we'll see that under the time to own program, we're able to serve lower income first-time home buyers than with our non-time to own program. And that's because that down payment assistance does help to drive down the overall sales price and therefore the overall mortgage amount. We're also helping people purchase that are younger and at sales prices that are higher than our non-time to own loans. This is really the same as it's been all year. Our first mortgage lenders, First World Mortgage and Total Mortgage Services continue to be our top producers, followed by Norcom, Homestead, and Guaranteed Rate Inc.
So Kayla, just quick,
Yeah.
our mortgage business is basically doubled, I guess, year over year. Is that the same as with a traditional bank or mortgage bankers? Is that,
No, I'll answer that. No,
Okay.
it's not. A lot of the mortgage banks telling us that we're one of the only reasons they're doing business with time to own and the down payment assistance program. So their business has slowed down. They had a lot of layoffs, whereas we have been increasing our volume, and it has basically doubled year over year.
Thank you.
Yeah, and I believe that we were recently recognized on the Fast 50 list for being the top quickest growing lender in the state of Connecticut for our residential programs, and I think some of our multifamily lending too, but I'm not 100% sure on that one.
Okay, great.
So then looking at our race and ethnicity breakdown, so far, a little over half of all of our borrowers have identified as minority. This tracks very similar to last year. And then our geographic distribution, a majority or a little under half of our lending occurs in the Harford County area, followed up by New Haven and New London, and then Fairfield, Middlesex, Litchfield, Tolland, and Wyndham. And this is a pretty typical distribution for our portfolio year over year. And then at the last mortgage committee, the commissioner had asked for some additional information on our delinquency and foreclosure numbers. So working with our loan servicing and finance team, we put together this quick 5-year chart to show delinquencies over time. So you'll see 60 to 90 days in blue, 90 plus delinquent days in green, and then foreclosures in orange. You'll notice right away that spike in delinquency in 2020, which reflects, that the upheaval that was occurring at that time, job loss, uncertainty with mortgage payments, which we did see a pretty quick recovery, that those serious delinquencies of 60 to 90 plus days have really gone down. That's primarily driven by many of the federal and state programs that came out to help homeowners prevent foreclosure and remedy delinquency. And so in speaking with our loan servicing department and the work that they do with other state HFAs, there's been some conversation that we really need to begin to watch these numbers closely, because we're seeing the end of a lot of those emergency assistance programs. We're almost done distributing all of the My Home CT dollars. Many of the programs that the lenders offer, they've already done refinances And with borrowers who were behind, so if they get behind again, there might be less options. So, over time, we're going to keep an eye on things because there is an expectation of a slight uptick in delinquencies because of those programs ending. And I think that brings us to the end. Does anyone have any questions?
Kayla, how do our delinquency and foreclosure rates for our mortgage products compare to the industry as a whole? Do you know?
I don't, Lisa, did you want to jump in? Or I know John Chilson is on as well.
John's
so
gonna jump in.
Yeah.
I can answer that. They actually compare pretty consistently month to month. We do track that. There's a report we prepare for finance, and we do compare our delinquency levels with both the rest of the state of Connecticut, New England, and nationally. And for the most part, we're right in line. Sometimes a little lower than the national delinquency, but generally fairly consistent.
Thank you.
So at the end of all the subsidies and such, we're looking over the next maybe 12 months to see if there's any uptick, because right now things look good.
That's right. Yeah, in addition to the programs that Kayla mentioned, a lot of the and then we'll start with at the peak of the pandemic. You'll recall that there were essentially a nationwide forbearance for most of the lenders, and the mortgage insurers were all allowing borrowers to go into some sort of forbearance program. And then followed that were some pretty generous loan modification programs, both through Fannie Mae, Freddie Mac, FHA, VA, and the private lenders. 70% of CHFA's borrowers are typically or mostly FHA borrowers in at least our whole loan portfolio. And the programs through FHA were especially generous, but there were limits as to how many times and how much you can modify your loan. And the concern is that quite a number of borrowers, both here in Connecticut and in a number of other states, where many borrowers have reached that limit. So if there is an anticipation that we will be looking at some redefaults, and the options for those borrowers will be fairly limited.
Okay, I'm glad we're watching it. Anybody else? Any other questions?
I just have one quick comment. So Kayla, great job pulling together that panel that we did with the Affordable Housing Seminar. And I just wanted to let you know that legislators from the Housing Committee are following up with meetings on some of the things that we discussed. So it was well received, and I think people like to hear a lot of the things that a lot of the information that we were sharing.
Thank you, Greg, and thank you again for being willing to participate. I thought it was a great conversation. And if anyone missed it and would like to catch it, I believe that the partnership is going to be uploading all of the sessions from the conference to their YouTube page. So recommend checking it out.
Great, thank you. Okay, next on the agenda is the multifamily report to be presented by Seema.
Good afternoon, everyone. So I'll go for the multifamily report. First up is the development spotlight. We are spotlighting Bayonet Street Apartments in New London. It's new construction, family housing with 28 units, 6 of which are supported units, and 6 are project-based subsidy units. And these are some pictures of the construction. We expect it to be placed in service January of 2024, and a projected final closing to follow shortly after that, around April of 2024. So this is multifamily at a glance. It hasn't changed much from last year at the same time. The only change was the TDC numbers are higher. The number of developments were the same. Total number of units this time around are slightly lower than what we had in November of last year. that just tells you that probably the costs are going up a little bit. And as we've seen throughout the year, it's the blue tab, the non-competitive, 4% LIHTC and miscellaneous, the dominant one in all three categories. Upcoming round, we have the 9% 2024 round. 19 preliminary applications were received. For HTCC, we have 91 open awarded applications, and for SSHP priority needs, there are 22 developments with 903 units, and with about 9.9 million in awards.
Seema, it might be helpful to see, like, we look at homeowners or single family year over year, because while your chart, you said it's a similar, I think it might be a small chart that just shows number of units, projects year over year, because that's kind of how we gauge whether we're, how much we're doing.
Sure, I'll include it going forward.
Okay, thank you.
Yeah. So for community engagement, we had a few ribbon cuttings, at Guzinski Park in Plymouth and Little Brook in Berlin. We had one groundbreaking for Wellington at Madison in Madison. Other than that, in early November, multifamily staff attended the New England Housing Finance Agency's annual conference. Approximately 40 HFA staff attended, and topics covered were HOTMA, Inspire, HUD Risk Share, LIHTC, average income tax compliance monitoring, HFA software comparison, operating cost increases, management, agent training, agent staffing issues, etc. Again, November 2nd, multifamily staff attended the Nehemiah conference, the New England Affordable Housing Management Association conference and trade show. And each HFA staff presented an update on their HFA initiatives. HUD focused on HOTMA updates. Same day, multifamily leadership and staff presented at the DOH Reimagining Housing event for 2 sessions, Built for CT and Sustainable Living for Tenants and Homeowners. Information was well received. November 3rd, we've already gone through the groundbreaking. Then November 13th, we presented at the Connecticut Affordable Housing Conference session for lower energy cost, go green, and building resilience using state and federal funding. The other presenters besides Jaffa were DOH, Connecticut Green Bank, Connecticut DEEP, and Hamden Park Capital on behalf of, I think it was for HUD. On the 17th of November, we attended the 2023 CMBA Mayors Forum on Affordable Housing. It hosted the mayors and first selectmen throughout the state of Connecticut to speak on what they were doing for affordable housing in their municipalities. For other news, we are gearing up for the 2024 9% LIHTC round. The pre-application period was run in conjunction with the DEP process, and it ended on November 1st. 19 applications were received, 3 of which were in the preservation classification, and majority of the submissions are in suburban high opportunity areas. For the 2023 HTCC round, reservation letters have been issued. And next step is for the non-profit corporations to secure a business firm commitment. And it is expected Eversource will purchase all the 2023 credits as they've done in the past. Next up, so we had one initial closing in October, 80 South Road in Farmington. and we had four final closings. Cherry Street Lofts in Bridgeport, Rocky Neck in East Lyme, and there were 2 SSHPs, Wapping Mews in South Windsor, and Pleasant Street Co-op in Enfield. And then here is a chart of table of prospective projects that are going to be coming to board in coming months. Next up is an upcoming transaction looking to come to board. This time around, we are highlighting Armstrong Court Phase 4 in Greenwich. The owner developer is a special purpose entity, but our contact is Anthony Johnson, of Greenwich Housing Authority. It's a gut rehab, family, 48 units, and most of all these units are in the 50 and 60% AMI band. And this has a pre-K on site. There are a few pictures on the left is like an aerial and then a current picture of what it is right now. And then on the right is a rendering of what it would be.
Wow.
Any questions?
What's your
Heidi,
biggest?
can I ask?
Yeah, sorry. What's your biggest challenge, Seema, these days?
In terms of, you mean
Whatever.
I mean,
Costs.
the cost, yes.
Costs,
Yeah.
Heidi. It's
Yeah.
on both ends, both on the development end and on the operational end, right? So we actually had some staff listen in on there was an insurance conference this past month, and we actually Tina and Seema, did you participate in that?
Yeah.
Listened in on it just to see what's happening. We're actually going to reach out to a couple of insurance companies that specialize in providing insurance to housing authorities to see if there's something we can do to help mitigate the cost to our end users. We've heard tales of 30 and 40% increases on insurance. And then on the supply side, while it doesn't seem that we still have some long lead items, but we don't see items right now that are 16 months out that are holding up projects. And any of the long lead items, we've been working with the developers to buy them up front, get them stored. We've kind of loosened our reins on stored materials so that we can provide for a timely construction. So, but the biggest thing is we're still seeing very high costs in terms of materials on the development side. Those are the two biggest obstacles that we face every day.
Okay, interesting.
And
Go
I'd like to point out one thing. I think for the last 2 weeks of November and through December, I think we have 7 closings that will have occurred. So that's a talk about a team effort. That's finance is doing everything they can to push these things along. We've got legal that's doing everything to get these pushed along, and then the staff on multifamily. They've all been working very well together. So these are very, very busy weeks as we try to close out the year.
Have you been able to shorten the time from the proposal to closing? I know that been a goal, but it's amorphous.
It's definitely my goal, and I'll be able to give it a lot more attention in 2024 as I turn over the reins on the Build for CT program to Vin. But yes, we've made some improvements, but we have to make significantly better improvements in 2024.
Okay, someone else
We may
had a
need your
comment?
input.
Okay, happy to give it.
Heidi, I had a question.
Sure.
Pat, I think if memory serves, I think we are coming to the end of the 10-year SSHP project launched in 2014. Is that right?
That's I'll have to check on that. We continue to receive allotments on an annual basis for SSHP, and we've actually worked with the commissioner to secure some funds for pre-development work, which has been a big problem for the SSHP portfolio. Deb Alter and her team have really advanced the SSHP portfolio to the same status as our CHFA portfolio. Another thing you should know is that previously, there's been limits as to the amount of each award to an SSHP project. We've now lifted that because what we were finding was that the bigger projects, we'd have to cut back scope. And so we weren't doing the complete job. So now what we're moving to is providing the pre-development fund so that they get their architects and such involved, get their planning done, get their CNAs done. And then on the flip side, when we go to fund it, we're funding what they need, not a limited amount, so that we can get the job completely done. We'd rather have fewer completed jobs than more partially complete jobs. So that's what we're moving towards this year.
That's great. Maybe this might be a longer discussion for a different time, but I think most of this is still based on that 2014 plan, which was a 10-year plan, which then would come to closure in 2024. If that's true, it'd be interesting to take advantage of that 2024 end date to look at how this what have we accomplished, right, in 10 years on SSHP? Are we doing what we need to do? The history of this, as people recall, is that those projects got consolidated and placed under CHFA, as at least I have been educated by others at CHFA to understand, because they were not being properly maintained over time previously. So the idea was to consolidate them and do a better job with regard to stewarding that portfolio. It'd be terrific to know where we are and how many projects in this state, what kind of condition are they in? Are we keeping up? Your point is well taken about costs rising, but where is that stock? Because one of the items we've talked about from time to time is that it's really important not to have any of our affordable housing going out of service if we can avoid it, even as we try and build more, right? But if units are coming offline, then that is already stock decreasing, not increasing. So it'd be great to have a look back at how we've done on SSHP and then what we're doing going forward with regard to that portfolio and to meeting the need to keep those units in good shape and serviceable going forward.
Okay. We will take a look at it and see what, we'll have to figure out the proper way to present the information, but we'll take a look at it since 2014. Obviously one of the biggest constraints all the time is the availability of resources to put towards these projects. So we're trying to maximize that. We are working under a priority. So it's the projects that need the most that are our priority. And we're going to try to get to them all over time. Again, the constraint is funding. But we've taken some great strides in 2023 toward addressing the needs of that portfolio.
I totally appreciate, Pat, that it's important to start with those that are most in need. But what I don't feel like I have a good sense of, and maybe it was discussed at the retreat or elsewhere, but where is that whole portfolio? And if we aren't keeping up, how do we think about making the case for additional funding or getting a plan in place over the next 5 or 10 years to sort out how we're keeping that portfolio moving the right direction? It might be time to take a look at that. But again, please check my memory. But I think it was a 2014 10-year plan that was the basis of this work originally, at least.
Okay, we'll get on that.
Thank you.
Sure.
Okay, thank you, Seema. Anybody else? Any other comments, questions? I guess we'll see everyone on Thursday for the meeting.
Yes.
Looking forward to it. All right. Anything else? If not, can I have a motion to adjourn?
So moved.
Thanks, Greg. Is there a second?
Second.
Okay. I think that's Wendy. I'm not sure. Cindy. All right. All in
Lisa.
favor.
Sure.
Lisa, thank you. All in favor, say aye.
Aye.
Aye. Thank
Aye.
you.
Thank you, everybody.
What if we didn't approve it?
You have to stay all night.
Heidi, I figured
Thursday.
out what Joe was saying. So